Hi, I'm Clyde from Blenheim Partners Executive Search and Board Advisory. Australia's resource and energy exports are forecast to reach $349 billion in 2021 and 22, up from $310 billion in the previous year. This represents an outstanding result in the context of the global COVID-19 pandemic, which has adversely impacted other mining nations along with the world economy. The outlook for Australia's mineral exports remains strong as the world economy rebounds from the impact of COVID-19 pandemic. High prices, good volume growth and a weaker Australian dollar are driving a surge in export earnings. Some moderation though in prices is likely in 2022 as supply rises and demand growth moderates. Export earnings are expected to rise by 14% to a record $349 billion in 2021-22. before declining to just under $300 billion in 22-23. In a snapshot, Australian oil prices look to have peaked and coal prices have recovered all of their 2020 losses and then some as global shortages emerge. Australian iron ore earnings are forecast to normalise sharply in the next 24 months after topping the $150 billion mark for the first time ever for an Australian commodity. The global economic recovery and constrained supply witnessed prices exceed US $230 per tonne in the middle of 2021, but reductions in Chinese steel production have contributed to price declines along with the recovery of the Brazilian supply of iron ore in the September quarter. Lithium exports are expected to almost match zinc exports in 22-23 as the race to electrify the world auto fleet gathers momentum. Exporters of aluminium, nickel, zinc and copper are also benefiting from the global move to low emissions technologies. Thermal coal prices have risen to their highest level in more than a decade in China as critical shortages emerged. High demand from major steel producing nations and problems with supply chains have seen Australian metallurgical coal prices reach multi-year highs, more than regaining all of the reduction in export earnings following China's informal import restrictions. With economic activity rebounding and the Northern Hemisphere winter approaching, all power utilities are scrambling to rebuild stocks. Prices are likely to ease back in the coming 24 months as supply gains match rising demand. Oil prices have more than regained the sharp falls of the COVID-19 pandemic. The oil price seems likely to be capped at US $80 a barrel as a further recovery in usage is matched by rising supply. In terms of risk, there are some to keep in mind. Global inflation, interest rates, resistant strains of coronavirus, along with further geopolitical disruptions with China as we look forward to our record export earnings forecasts. Despite these risks, there are concerns with the current committed mining pipeline of 57 projects worth $41 billion over the next 3 years that will require over 20,000 people on site employees to deliver. There exists a challenge to avoid a scenario where nationally significant mining projects are delayed by skills and labour shortages, or competing for engineers, trades and skilled operators with the $100 billion worth of public infrastructure projects reportedly in the Australian pipeline, not to mention other global infrastructure projects such as the Biden-approved US $1.7 trillion program. Australia's mining industry is facing new workforce demands at levels not seen. It is clear that securing the pipeline of skills to support mining project growth to 2024 will be a significant challenge. It has been put forward that key stakeholders such as government, employers, unions and industry peak bodies need to collaboratively design a plan to secure a workforce to deliver major resources and energy projects that provide Australian construction workers with earnings more than double the industry average and the award pay rates to eliminate risk that ensures Australian investment and growth of our nation. With regard to executive leadership, we are seeing the following themes: extensive movement as a result of the heightened M&A activity, a willingness to explore opportunities with more cross-border movement, inflationary pressure on executive remuneration, and lastly, increased demand for executives with applicable skill sets for the energy sector.